Now what does the company do? The company says there are 10,000 shares out here which is at 10 rupees face value and the value is 1 lakh. Retained earnings, so far I have retained about 250,000 out there. So this money belongs to the equity shareholders. So what do? Let me say that I am issuing a 1:1 bonus, that is for every 1 share you are holding I am going to issue 1 more share. So what happens? The number of shares become 20,000, and that means if it becomes 20,000, face value is 10 rupees, that means what is the value of the share? Value of the share is 2 lakhs. Does not mean that I am collecting the other 10 rupees per share from the public. What do? I will say whatever is the retained earning which was 250,000, I just make this 150,000, I move 1 lakh from retained earnings out here, to basically what is called as in this, I move this 1 lakh from the retained earnings out here. So what happens? For every 1 share what you are holding, you are getting 1 more share from the company. They can even issue not 1:1 bonus, they can issue 1:2 also, or it can be any ratio. If they issue 1:2, what happens? The 20,000 becomes 30,000 out here, this becomes 3 lakhs, and then this retained earnings at the company is only 50,000. Your net worth of the company does not change. So for every 1 share you are holding, you are getting 2 more shares from the company out there. So totally you have 3 shares. What is the advantage for you? You go to the market and sell it whenever you want, not that the company is thrusting cash on you. Whenever you want it, you liquidate it. Number 2, what is the advantage for the company? Tax, profit, nothing, no profit. Simple, no cash outflow. All that happens is 1 code on the, not even paper today, demat, 1 code on the computer and that is it, nothing, no cash outflow. Understand? There is no cash outflow happening for the company is also benefited in the process. So when the market moves, the prices in the market moves, it is in anticipation of these kind of performances that is there. So what happens? First 5 years the market is just moving. Why market is just moving? Because they know that eventually somewhere or the other, somehow or the other you are going to get the money, whether it is in the form of cash or in the form of stock dividends out there, and then you sell it and make money. That is what is the crude way I have explained what you call it as, how do you get what is called as bonus shares and stock dividends. Hold it for 1 more minute. Now what we talked about, equity share, we talked about retained earning, we talked about net worth. Supposing after the 5th year, after they have done the bonus shares, something happens to the company and the company subsequent year posts a loss of 75,000. So what happens? The company posts a loss of 75,000, then what happens in this particular case out here? It is basically negative 75,000 out here. Yeah. It is basically negative 75,000 in this particular case. Then what happens to the total out here? Then it is 2,25,000. That is what happens. 3rd year, huge loss of 1 lakh. Then what happens? Further loss of 1 lakh. That is total loss of 1,75,000. Then what does it become? 3 lakh minus 1,75,000 is 1,25,000. That is what it becomes. 4th year, further loss of 2 lakhs, then what happens in this case? 2 plus 3, 2 plus 1.75, 3.75 lakhs out here, negative 3.75 lakhs. Then what happens in this particular case out here is basically net worth becomes negative. That is why net worth gets eroded. When net worth gets eroded, value of the equity is negative. So the company ceases to exist at that stage. Am I with you on this? Now all questions. First.
This is how the stock prices increase or decrease?
No, this is not how. This is how what happens in the company. Stock price increase decrease is independent, sir. Don't even bring that here.
Because that's how it is reflecting on the market. Right?
Stock prices is expected to reflect the performance of the company, which is one attribute, which is one of the attribute.
And that's what I'm asking. Is this the way?
It is this attribute depending on the performance. As this negative keeps increasing, it keeps tanking. Positives keeps increasing, company is expected to do well. For example, there might be huge amount of retained earnings. The company can have a corporate governance issue, then prices will never move up, right. So, that is one of the attributes. There are hundreds of attributes around which will decide the movement in the market. Huh? Whatever, it can be anything, that is why I said it can be hundreds, may not even be a priority sector as of today, expected to. NOC values increase, additional shares?
No, so if they give 1:1 bonus or 1:2, the number of shares are going to increase. So I was just wondering if the company's value will decrease.
Value will decrease, how will the value decrease?
More diluted.
It can, that is in the market, so it can get more diluted. See, theoretically what happens? A share is 100 rupees as of today in the market, a 10 rupee share is selling at 100 rupees in the market. Now, I issue 1 bonus, then what happens? Theoretically the price should come down to 50 for the value to remain the same. The price will come down to 60 or 75, value is always higher. So, 75 into number of shares is double, right. So, the value will not necessarily decrease.
Just trying to understand the rationale of bonus share. Apart from the sentiments that you're distributing into holders, maybe promoters can sell shares. What is in it for the company?
Promoters selling the shares and all is independent.
They are also shareholders.
They are also bonus shares, everybody gets it. What is in it for the entity? Entity is basically run because of the investors. Entity is garnering all the money, not distributing to the investors, then the price in the market will never move up, right. Then people would be just trying to get rid of it.
They can sell the original equity also.
Which one?
They can sell the original equity.
No, original, anything, there is no, everything is original, sir. Bonus share is also original, there is nothing denominated, everything is original.
No, before I get the bonus share.
Before you get the bonus share, you can sell it. You sell it, for a simple, as she asked, share price is 100. Before there is what is called as cum bonus, there is ex bonus, book closure date. That is, if the share is registered, there is a book closure date which is indicated by the company. On this particular date, whosever name is the shares registered, they are the ones who are getting the bonus. So, naturally, if the trading activity before the closure date, book closure date, the price of the share will always be higher, because whoever buys it is going to get one more share. After the book closure date, if you are buying it, you are buying only that equity share, the bonus is not going to come to you, the bonus is going to go to the previous owner. So, obviously the price will be less, that is all. One second, I'm sorry, I am coming in an order, that is what I do not want to miss anybody, yeah. Not you purchase a share, I never said that. Face value is at what the price the share is denominated. You buy it at, purchase it at a price which could be far higher or far lower. Let us not worry about that. It is at which it is denominated.
Yeah, face value is what they say that is the company declares, and then
Company the share is denominated. That's all.
market value is what I sell when I sell.
Market value is independent.
What is the book value?
Book value is what we arrived. What is the book value of the share now? Negative.
Book value is only in books.
Book value is only in books. Yes, that is why it is book value.
It doesn't have any significance.
It has a lot of significance when you do the analysis. At this stage, that is the book value is what is the share worth based on the performance, the real worth. What do you call it? Is the intrinsic real worth of the share based on the performance. That is, the company decides tomorrow to sell all their assets, clear off all their liabilities. That is what you are expected to get. IPO is, there is no additional share. That is what, when I issue the shares, that is an IPO. I issue 10,000 shares at 10 rupees each, and that is what I have issued, and that is what comes out here. Now, today I decide, my company decides, I have 30,000 shares out there. Imagine, forget about the last part of it, imagine that is making a profit. I will, for the benefit, let me just erase this part of it. Okay. Now, it has 30,000 shares out there. Now, I decide to increase my share capital. I decide to issue new shares to the public. Yes, then what happens? My number of shares instead of 30,000 becomes what happens? I decide to issue 30 more thousand shares. My number of shares becomes what is called as 60,000 shares. What is the value out here? Value is 10 rupees. So, what happens? This becomes 6 lakhs out there. Face value will not change, but they will not issue at 10 rupees. What they will issue? They will issue it at a premium, they will charge you a little more. How do they calculate the premium? We will come to that a little later. Okay. Next row, yeah. I am just going one by one row, sir. Definitely hold it, I will definitely come to you. Balance sheet, that is what it said, after equity capital. There is a balance sheet which is there as part of the manual what I have given of Maruti Udyog. You can just look at it, it will come under the heading called as reserves and surplus immediately after share capital. Some people will show it as retained earnings, some will represent it as profit and loss account balance, both mean the same. Yep.
Net worth is the book value, right?
Net worth is not the book value, net worth is net worth of the company. Net worth divided by the number of shares is the book value. Net worth divided by number of shares is the book value per share. Yeah, it is an earning which you have retained. It is an earning of the company belonging to the shareholders which the company has retained. That is why retained earning.
So, does anybody who has invested, you would be knowing that so much amount has been retained?
Of course, yes. Of course, yes. Public limited company, any company which is listed, please understand, any company which is listed is supposed to put it in the public domain, the balance sheet, P&L and cash flow statement, all the 3 statements at the end of every year. It is in public domain. How well it is window dressed, that is up to you. Normally from retained earnings, yeah, normally only from retained earnings. There are reserves and surplus has lot of things in addition to retained earnings, we will come to all that in a few minutes, not today's class, maybe subsequent classes. On the interest there is no tax, the company does not pay, only on the dividend it is tax. We have to hold it, you have to hold it, sir, till one more class.
No, I am talking about the individuals who are actually.
Individuals, what you get on hand is your income. If company has declared 100 rupees as the interest to you, you are getting a 100 rupees dividend warrant or interest warrant, you pay tax on that. Dividend is not taxed, interest is taxed in India.
Yeah, but it is my income. Is it a TDS they have to?
Which one? The company will not do any TDS, they will just give it to you. Beyond that, you will have to do it.
So the decision of retaining the earnings in the company is made by the shareholder?
It is made by the board. Board as a representative of the shareholder. If you are, for the answer is yes to your question. The company can issue shares, that is, it is not bonus share, it is what we call it as at that stage, we call it as not as an IPO, we call it as a seasoned offering. That is, the company is again coming to the market and issuing shares to the public and collecting money. In a bonus share they do not collect money, in an equity share they can collect money. First time they issue IPO, initial, I is initial public offering, first time issue, subsequent issue seasoned offering. Face value will never change. If face value changes for everything existing as well as new, otherwise face value does not change. Face value can be 10 rupees, 1 rupee. At this stage the company can say, I am going to do a stock split, I am going to do a stock split, I am not going to value my shares at 10 rupees, I am going to value my shares at 1 rupee. If I decide I am going to value my shares at 1 rupee, what happens out here? It becomes 1 and then all that happens is one more 0 gets added there, that is all. One more gets 0 added out here, I have added a 0. This does not change, this remains the same. With you on this, sir? Pardon me? I am talking only about equity, ma'am. For the last 20 minutes I am talking only about equity, I never talked about anybody else. It was earlier you had 10,000 shares. Now for example, out of 10,000 shares you had 1,000 shares. Now I issued a 1:2 bonus. For every 1 share I am giving you 2 shares. So what are you getting? You are getting 2 more 1,000 shares. 3,000 shares is what you have. Total number of shares in the books is 30,000 shares. It is still the same, 10%.
Is there any norms for fixing this face value of
There are norms, sir. It has to be in multiples of 1.
multiples of
It cannot be in decimal.
that is okay. But is there any upper limit?
Nothing. There are shares which are which are even now there are some shares which are face value is 100 rupees. Earlier 100 rupees was the norm, then it became 10, then it became 5, 2, now it is normally 1 rupee.
Sir, if I issue additional shares
Ah.
to raise money
Ah.
at the same face value, for example, 10 rupees,
Ah.
but it is sold at 100 rupees
It's sold at 100 rupees too?
to the investor.
Agreed.
Where does that 90 rupees accounted?
There is a 90 rupees accounted. Okay, fine. Now that is what we call it as a premium. Now I will come to that. Now that you have raised that question, I am moving to the next aspect. I am sorry, this sheet I think we may not be able to do it today. We will do it in next class. We are going slightly slow, but I hope it's okay. But I want to ensure that all of you get the basics right, then it becomes easier. Now, why is premium charged and how is premium charged? Let us look at it. Supposing I say that I start a business, let me say year 1. I have started a business, I have not done anything. I have contributed a capital of, let us say, 10,000. Year 1 I make a profit of about what is called as, this is at the beginning of year 1. Now I will say year 2 at the beginning out there at the end of year 1 I have made a profit. Let me also talk about the profit out there. The capital remains the same. I made a profit which I have retained in the company. I made a profit, or what we call it as retained earnings, of about, let us say, about 3,000. What is the net worth of the company? 13,000. Now let us even say that this capital of 10,000, okay, let us retain let us not even divide it into equity, fine. Now I move at the end of year 2, what is called as, I move to what is called as year 3, again beginning of year 3, beginning of year 3 or end of year 2. There is a capital of 10,000. There is a profit which is there, or retained earnings, or whatever name you would call it. First year I had retained 3,000. Second year I have made more profit. Now I have made a profit of 5,000. Now what happens is my retained earning is 8,000. Now what is the worth of the company? The worth of the company is 18,000. Now I decide, now he decides to become my partner, or what is called as, he decides, not even a partner, he decides to invest in my business. He says, I will contribute another, what is called, let us say you have contributed a capital of 10,000, I will also contribute another 10,000 and become a 50% what is called as owner of the business. Now when he contributes 10,000, if I am an idiot, what I will do is I will say, yes, I will give you a 50% share, you come and contribute 10,000 out there in the business. Then what happens is at the beginning of the third year, if he contributes what is called as 10,000 out there, then the capital becomes 20,000, and this also what happens is becomes 28,000 net worth. The same evening he decides to fight with me and he decides to leave the business. He says, what is the business net worth? Net worth of the business is 28,000. So what do you have to give me? You have to give me 50% of it. He will just take 14,000 and go away from me. So I will just be a loser in the process. Now you understand. So what I tell him? I tell him that when you join this business itself, I tell him, boss, you have to get me 10,000 as equity or capital, another 8,000 as what I call it as premium in the business. I will say you have to get me, please do not write, you have to get me another 8,000 as premium, that is what makes it 50% in the business. So now the business is 20 plus 16, that is 36,000 rupees out there. So if you fight in the same evening and go, you take your 18,000 and go, I do not stand to lose anything. That is the base minimum. Even to do that I should be an idiot, but normally I will not do that. I will tell him, first 2 years the risk of the business is very high, I have taken the risk. Now third year when you are coming in, the risk of the business is low and already there is a 8,000 retained earning that is there in the company out there, I should also be compensated. So when you come in as a partner, you bring in 10,000 as equity, 10,000 as capital or equity and bring in another 12,000 as premium. So what happens out here, I will tell him the premium what you are paying is 12,000. So now what is the value of this 20 plus, that is what is this becomes what is called as 40,000 out there. So he has totally brought in 22,000 into the business. Now what is his share in the business? His share in the business is only 50%, 20,000 out there. What have I gained? I have gained another 20,000. That is basically my entire effort is compensated. That is what is the premium. This is the crude way again how premium is arrived at. Now I think I have answered many questions out there. How is the premium calculated, etc. Am I with you on this? Let him not agree, then he will not invest. If he has to invest in my company, he has to agree. Sir, when companies issue shares at a premium, nobody forces you to apply. Nobody is forcing you. You get greedy because your neighbor is investing and making money, you also want to invest. That is how we all invest. You, because you see value, because in the first 2 years itself with a 10,000 capital I made a 8,000 profit out there. You feel there is a huge potential to invest and grow, what kind of return what you see in the return, right, almost very high return, then he will sort of, he decides because of that. Everything cannot be added to the capital. I will say their capital is only 50% capital. If I add the entire 18,000 to the capital, then what is his ownership in the company? Larger. And what am I getting? Nothing. With you on this, sir? Huh? Premium does not grow. Premium stays like that. Premium stays like that. Premium does not grow. Unless I collect premium, it does not grow. Only way is I have to go on collecting money.
Premium value, suppose after third year I am issuing this, the next year I issue after 5 years or 10 years, I will definitely going to increase.
Of course, you join at the end of 6 years. I have, by then, my retained earnings has grown to some 50,000 with a 20,000 capital, then I will charge at least a bomb from you. When you dissolve the company, this is net worth of the company. There is no division between premium, equity, etc., etc. Whatever money is left, that is at this stage divided by number of equity holders, that is all. Premium is part of your net worth, of course. That is all the money. Net worth is nothing but all the money that belongs to the equity shareholders. All the money that basically belongs to the equity shareholders is what is called as net worth. When I say all the money that belongs to the equity shareholders, it could be share capital which belongs to the equity shareholder, retained earning belongs to the equity shareholder, premium belongs to the equity shareholder. In addition to that, having said this, now I have to move further slightly on this before I take more questions on out here. What happens is, normally from the profit what I have, I cull out some part of the profit for some kind of what I call it as reserves. It could be what is called as general reserve. It could be redemption reserve. Reserve is nothing but what you call it, you know what is a reserve? Redemption reserve, capital redemption reserve. It can be debenture redemption reserve, it can be preference capital reserve, redemption reserve, it is all what is called as redemption reserve. When I say redemption, redemption means what? At the end of the period, payback, for that I create a reserve, that is all what you call. All this money is culled out of what? Culled out of profit, not utilized. This will also come and sit somewhere out here along with your what is called as your net worth. Before your net worth is arrived at, equity, retained earning, premium, all reserves, that is in short all money belonging to the equity holders. That entire bundle is what we call it as net worth, and that is what, other than equity, all these go under a heading called as reserves and surplus. All the other aspects, premium, your retained earnings, your kinds of reserves, all this go under a heading called as reserves and surplus in the balance sheet. In this particular case, if I have to move up out here, yeah, I am back here. What I said, he has brought in 10,000 as capital, he has brought in 12,000 as premium, my net worth is 40,000. Same evening he decides to fight with me and leave. What is he eligible? He is eligible for 50% of his net worth. What is 50% of his net worth? 20,000. What did he contribute? He contributed 22. He has lost 2,000 in value. There is no question of dilution here. Because at this stage, if you have to have an investor at par, then there should be something else that should be going on behind the scenes.